Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, we're going to talk about how margin calls work for SBLOCs. If you don't know what an SBLOC is, that's a securities-backed or securities-based line of credit where you are borrowing against your portfolio of stocks or bonds. I'll link below to my video with an intro to SBLOCs that explains what these are and how they work and how you can use them yourself. While I think SBLOCs are a great strategy to build wealth and something that I use all the time, there are, of course, risks that come with using SBLOCs. One of those risks is a margin call. So I'm going to walk through really quickly how a margin call works for SBLOCs. It's a little bit confusing. I've honestly never really seen anyone talk about this correctly out there. So I just want to spend a few minutes talking about how margin calls work with your SBLOC, and then you can think about, how to make sure you watch out and prevent any situation where you get too close to a margin call for yourself. So to start with, what is a margin call? So a margin call is when your portfolio of stocks or bonds, whatever you're using the SBLOC against, drops below the margin requirements. So each broker, if you're doing this at IBKR or somewhere else, each broker is going to have different margin requirements. So it's important that you make sure you check the requirements at your broker before you do an SBLOC, because it can be very different. And you need to understand when, what those thresholds are and when they might come into place. So I don't like the term margin call really when we're talking about SBLOCs. I think it confuses the strategy. So, with an SBLOC, think about it more in the sense of when you have insufficient collateral for the loan. So when I think about margin call, I think about when people are trading shares on margin. So I don't like that strategy. I never do that strategy. I think it's very risky and it's something very different. But here what we're doing is we're actually borrowing against our stock. So think of an SBLOC as a loan with your shares of stock or bonds or whatever as collateral on that loan. So a margin call with an SBLOC is going to happen when you have insufficient collateral for your loan. We're going to talk about maintenance margin. So there's a lot of terminology. If you log into your account, where you have an SBLOC, you might see all these different terms out there like equity with loan value, that type of thing. But you should see maintenance margin. That is the relevant term where we're talking about having a potential margin call and thresholds we need to maintain in order to avoid a margin call. So you need to check what your broker's maintenance margin is. It's usually 25% of the portfolio value. That's what it is at IBKR for my SBLOC. But if you're doing this at, always check with brokerages. Different accounts have different margin requirements too. But you want to check what that maintenance margin is, because that's going to be important when you're calculating the threshold for what you have to, maintain as far as collateral in order to avoid a margin call. So what happens when you have a margin call? So a margin call, it depends on, again, the broker, what they do. There may be some brokers out there who notify you that you have a margin call, or you're very close to a margin call to give you a heads up. However, that is not always the case. What does happen, even if they do notify you, if you don't fix the issue really quickly, they are going to automatically start selling your shares. So, if you've got 1 million shares of, Apple in there as collateral on your SBLOC loan, and the market drops so much, or Apple's value drops so much that you've got a margin call, then you're going to just start having your shares sold for you. They're not going to ask you what shares you want sold. They're just going to start selling enough shares to make sure that you get back up so that you satisfy their margin requirements. So why is this bad? I mean, you don't want your shares sold. That's kind of the whole point of using an SBLOC. So, I use SBLOCs as a way to implement the buy, borrow, die tax strategy. So I don't want my shares sold because that's going to result in taxable gains. So they're going to sell your shares. You're going to have taxable gains, and most likely you're going to have some gains in there. You're going to pay a bunch of tax on it. There's nothing you can do about it at that point because you've realized the gain, and you don't have any ability to control what shares get sold. So you could have short-term capital gain when you could have sold enough shares that would have given long-term capital gain and had a better tax situation. Or you could just have shares, maybe something really bad happened for a temporary drop in a company, and it's going to go right back up in the future. You wouldn't have wanted to, for example, sell your shares when the COVID dip happened and that crash happened, because it went right back up and it went to historic highs after that. So you don't want to have a situation where you're just not having control over what shares get sold, because you could have some losses, let alone the tax issue, set that aside. You could have some losses that could have easily been avoidable if you didn't sell that specific shares of that company for some reason. So you want to have control over your portfolio, and you don't want to have taxable gains. Another thing I'm going to say though, while you do want to avoid a margin call, it is something, I'm not trying to downplay the risk of a margin call. It can get very messy. It can get you in really bad shape. It is not the end of the world. People make it out to seem like if you have a margin call, the zombies are going to come and take your home and take everything. Lots of people have margin calls. I know I have not had a margin call because I have good strategies in place in order to avoid margin calls. I have a good plan in place. So I haven't even come close, luckily, to date. I know a lot of people have had margin calls and they've lived to tell the tale. I mean, it's not the end of the world to have a margin call. You see people say all the time with buy, borrow, die or SBLOCs, you have to watch out if the market drops 50%, you're going to be in big trouble. It's going to be awful. Well, no, it's not necessarily the end of the world. You can recover, right? And also, they're wrong, right? So they always say 50%. That's how you know someone doesn't know what they're talking about when they say, what if the market drops 50%? You actually could have a margin call in your SBLOC way before the market drops 50%. So the market doesn't need to drop 50% for you to have a margin call. So, this 50% drop is just, that's, I don't know if people don't understand SBLOCs as opposed to, buying shares of stock on margin or what the difference is. But don't let a margin call, the risk of a margin call, stop you from doing a good strategy. Yes, you could have a really bad situation. I'm not saying it couldn't be bad if you had a margin call, but you can plan, for what you're going to do when you get close. Yes, the market, there is always going to be drops in the stock market. That is just a fundamental fact. That's the reality. It is somewhat volatile in the sense that, we have dips. Over time, the stock market has always gone up. But there are temporary downturns. And yes, there are a lot of people who've gotten margin calls. I'm going to link below to my video that you should check out, which are tips and strategies that you can use to avoid a margin call, or if you get close to a margin call. But don't let the risk of a margin call or people out there telling you that the world's going to blow up if you have one stop you from using this strategy. The other thing that I want to point out about SBLOCs is people talk about they're so risky. They are usually the lowest cost of borrowing available. So they're very comparable to mortgage rates, which is the lowest cost of borrowing, meaning interest rates are the lowest. I never have seen interest rates lower than the rate I pay on my SBLOC. So why would a bank lend to me at such a low rate of interest? That means the bank themselves don't view the SBLOC as very risky. If they did, they would charge a much higher rate of interest. So that's just a fact. That's just a good understanding of how banks operate. I don't want you to be under the misconception that I'm trying to say there's no risk with SBLOCs, but I do want you to understand that while people, shout that this is the most dangerous thing that you could do, why would the bank lend to such a low interest rate if it was so risky that they would go out of business really quickly, right? So banks view this as a very safe way. And, they lend at low rates. That's not to say, that buying shares on margin is, less risky, because you can also get that at low rates. That is a very different thing, right? So buying shares on margin, when you're buying shares or you're levering up, the shares and the way you do that, that is not what we're talking about here. I am talking about I'm borrowing, I'm taking out a loan, my stocks are collateral on that loan, and I'm paying a very low interest rate on that. The last thing I'm going to mention about this risk of a margin call and people, being very scared to do that. As I mentioned, I use SBLOCs for, to implement the buy, borrow, die tax strategy. That is the best tax strategy you can do. That is the strategy that the wealthiest people in this country do to build wealth while paying little to no tax. SBLOCs, in my opinion, are the way that the practical everyday, investor like you and I can use this if we're not billionaires starting the next Amazon. I think SBLOCs are a great strategy to use and to do buy, borrow, die. So when you think about that, so what you're doing is you're borrowing against your shares of stock. The stock is the worst investment, right? So I borrow against my shares of stock and I invest in something else. That secondary investment is always better. If I couldn't borrow against my shares, I would sell the stock and make that secondary investment, whether it's real estate, whether it's private equity, whether it's my own business, whatever it is, that investment in my mind is better than investing in the stock market. Otherwise I wouldn't do it. I would just put all my money in the stock market and, be completely hands off. But that's not the case, right? You're only doing buy, borrow, die because you wanted to sell those shares or you needed that cash. But what you're going to do instead of selling the shares is avoid paying the tax by borrowing against it. So if there is a margin call and some of my stock gets sold in the future, I don't really care. I'm not going to lose a lot of sleep over that because that was my worst investment, right? I wanted to get out of that investment anyway, and that's why I'm doing buy, borrow, die. So again, margin call, yes, it is risky. Yes, you can get yourself in trouble. Yes, an SBLOC is a loan and you've got to pay that back and you're liable to pay the bank back for that. If your portfolio goes down to zero, you still owe the bank, right? So you're not going to get off the hook of that. But do not let the threat of a margin call shy you away from a very great investment strategy. So check out my video that I linked to below on tips for avoiding a margin call. Yes, it's something you need to plan for, but don't let it scare you away from an otherwise what I think is a very great investment strategy for some of us. So let's just talk really quickly about a quick example of how these margin calls work on SBLOCs. So as I mentioned, you've got to check with your broker about what that maintenance margin is. It can be very different. Some brokers don't let, you even do an SBLOC up to 50%. Some of them let you go above 50%. I'm never going over 50%. I'm never even going close to 50%, to be honest. But let's just say, to make a clean example, let's say we have a $1 million stock portfolio and I want to do a 50% SBLOC. I am not advocating you do that. I would never do a 50% SBLOC, but I'm just trying to use, clean numbers here. So you've got an SBLOC of $500,000 because you borrowed 50% against your $1 million portfolio. Let's say you're using a bank that is, 25% maintenance margin. That means your maintenance margin is 25% of your portfolio value. That will change, right? So right now my portfolio value today is $1 million. So my maintenance margin is $250,000, but it is a factor of your portfolio value. So as your portfolio value goes up, your maintenance margin is going to go up. As your portfolio value goes down, your maintenance margin is going to go down because 25% of a lesser number is a lower amount. So just keep in mind that that's going to change, it's going to change every second, right? As the stock market values change, as your account value changes, that's going to change. So you have to watch that. But, I'm just going to keep it clean. We have a maintenance margin of $250,000. What is my net account value? So net account value is a function of the value of your portfolio right now, less the loan, the SBLOC balance. So if I have a $1 million portfolio and I have a $500,000 SBLOC, my net account value is $500,000. That's how much net liquidity or whatever, I have in my account, because I have $1 million of stock, but I owe the bank $500,000. So that's the net amount. Again, that's going to change. That's going to change every second as the value of your portfolio changes. You are going to, have a different net account value. Also, keep in mind, if you're not going to pay down the interest on your SBLOC and you're just letting the interest accrue, your SBLOC balance is going to increase. So it's not going to be $500,000. It's going to be $500,000 plus whatever the daily accrual of that interest is, and that's going to go up every day. So that is going to go up. It's not just purely what, cash you borrowed against your shares. It can be plus the interest if you're letting the interest accrue. Dividends might pay down that interest, to some extent. In some cases, it may pay all of it or exceed that. But just keep in mind that SBLOC balance is not going to just stay a clean $500,000 if you're letting the interest accrue. It's going to increase over time. So on this fact pattern, you are going to have a margin call if your net account value, here $500,000, minus your maintenance margin, here $250,000, is less than zero. So if that amount goes to negative, you've got a problem and you've got a margin call. And if you're at IBKR, they're going to start selling your shares. Usually IBKR is not going to ask you or give you a notice. They're going to just start selling, right? And a lot of other brokers are that way too. They're not nice enough to kind of give you that heads up and give you some leeway. So, that's when you've got a problem. So you've got to watch out for that. Make sure you're not getting close to that. Keep in mind, this is going to change all the time. This can fluctuate wildly, throughout the day and throughout the week and throughout the month. Just depends on how the market is, how your portfolio is doing. And again, just check what your broker's, maintenance margin requirements are. I have a separate course on the buy, borrow, die tax strategy. If you haven't taken that course, I highly recommend it. I go through this in more detail, how this margin call works. I also share with you a spreadsheet that you can use to track your margin call and calculate it and, plug in your own numbers to do that. But it's important that you understand this. Again, I don't see this talked about a lot. I've seen some people talk about margin calls on SBLOCs, but I've never seen it done correctly. So it's important that you understand, yes, it's a risk. Don't let it deter you necessarily from doing an otherwise good strategy if the strategy makes sense for you. As always, you have to do your research. You have to understand what you're doing and what you're investing in. You have to make the educated decision whether or not this investment strategy is good for you. But do not let the risk of a margin call and a lot of false information and, fear mongering out there about margin calls prevent you from doing something if the strategy is a good idea for you. So hopefully you found this helpful. Check out my other video where I talk about tips for avoiding a margin call in the future.